All right. Very important message for Q4 of 2024. This is a message I don't think enough home buyers are listening to. And quite honestly, I think it's going to cost you in the long run. So, as I always do, I like to consult home buyers. And I got a lot of home buyers who are telling me, Matt, I'm waiting for rates to get to 5.5. I'm waiting for rates to get to 5.75. If you've been paying attention, rates came down leading up to this mid-September Fed meeting, and they got down to about 6.1%. We locked some people in the high fives. And then after the Fed meeting, a quick spike, and now we're back up to about 6.6%. Right now, as we start to cool off and less transactions are happening, which always happens in the fourth quarter of every year, that paired with a little interest rate spike that does scare some people off from buying, you've got an amazing opportunity to go in there as a buyer and negotiate quite probably the best deal you're going to get in the coming years. Now, a moment in time when you lock in an interest rate is just that, right? It's a moment in time. Most people who are going to write a loan at 6.6% or 6.5% or 6.25%, whatever the interest rate ends up being today, is not the rate you're going to be in for the long term. And I'm not going to hit you with the corny, date the rate, marry the house type BS. But the truth is, you're going to get the best deal when everyone else is afraid, when everyone else is ducking and hiding and is fearful, right? Like Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And so I don't want to sell you anything. I just want to tell you, consider going home shopping in the fourth quarter, finding yourself an amazing deal, not even caring or looking at the interest rate, knowing that you're going to refinance that in the future. Now, the great part is a home that might have sold at $750,000 when interest rates came down and someone could lock it in at a 5.75 or 5.99. If you get that home for $690 and maybe you've got a 6.5% interest rate, in the future, you still paid $690 in the summer of 25 or the first quarter of 2026 when you refinance that into a 4.7. Now, I want to nerd out on you just a little bit, so hang with me here. I want to show you this chart. I shared this on a podcast earlier today. It might be 36 months from now, but rates could get into the mid fours. And when they do, rest assured, with limited inventory, you will see a whole bunch of home buyers. You will see a bunch of demand, and that's going to have an upward pressure on prices. So be glad that we've got the opposite happening right now. We've got downward pressure on prices. There's not enough buyers, right? And that's why stuff is sitting. I'm seeing it even in the hottest neighborhoods, in the best markets. Days on market is increasing. The price reductions are increasing. I think Sacramento, we looked at last, like 40% of homes had a price reduction. So with all that said, let me try to make this short and not nerd out too much. The 10-year treasury is directly correlated with mortgage rates. And if you take the 10-year treasury historically and add a couple percent to it, that's where 30-year fixed rate mortgages are. Today, we've got 4.04 on the 10-year treasury, and 30-year fixed rates are in the mid sixes, call it 6.5. So it's about a 2.5% spread. That's higher than normal, but we can still use that 2.5%. Normally it's 1.8. For our example, let's say that it comes down a little bit closer to normal, and the difference between the 10-year treasury and the 30-year fixed rate mortgage is 2.25%. What this chart tells you is the last 9 times we've had a Fed rate cut cycle. That's what this is. September 18th was the first cut of a cycle. 8 out of 9 times, the initial reaction is a spike. 8 out of 9 times. So when rates got down to 6.1, we had the first rate cut and then rates went up. People are like, what is happening? Historically, that's what normally happens. 8 out of 9 times. And so that 3.70 went up 4.06. That ceiling it may go to 408, who knows? But long term, after all these Fed rate cuts are done, 12, 18, 24 months from now, we're going to eventually hit a cycle low. And this is talking about the 10-year treasury. If it started at 3.7, and historically, the percent of decline is about 37%. That's what this number says. It might be covered up by an arrow when I screenshotted it. 3.7, 37% decrease. That means the 10-year treasury, if we go off averages at the end of this cutting cycle, the cycle low is going to be 2.35%. Now add the 2.25 that we're talked about, right? Right now we're 2.5% spread between the 10-year and the 30-year fixed rate mortgage. Historically, it's about 1.8. Let's add 2.25. 2.35 plus 2.25, 4.6% 30-year fixed rate money. If and when that happens, and it's possible, it's probable if you look at history, I promise you, the home you buy today will be more expensive. So do you want to wait until rates get lower, demand comes flooding back in the market, and everybody drives the price of housing up, and you pay $875 for that house today that was $750 at its peak and could probably be purchased for $690 in a market that feels slow? Buyers are on market for 60 days and they're giving out deals. I don't know. Let me know if you've got any questions at all. I'm more than happy to chat. I'd love to get on a phone call, talk about your specific goals. If now's the time for you, great. If it's not, no big deal. But don't be afraid of higher mortgage interest rates. Be happy for them, quite honestly, because it's going to be the thing that creates a great deal for the buyers that are active. Thanks for watching. Talk to you soon. Bye-bye.